In 2000, Enron reported revenue of roughly $100 billion. It was praised as one of the most innovative companies in America. It traded energy, it built pipelines, it talked about broadband, water, risk markets, and the future of almost everything. Then, on December 2nd, 2001, Enron filed for Chapter 11 bankruptcy protection. The collapse was so fast that it still feels unreal. A company that had been sold to the public as a model of the new economy became a symbol of corporate fraud, destroyed pensions, shredded credibility, and accounting tricks that most people could not explain. But Enron was not just a fraud story. It was a money story about a company that made market confidence part of its capital structure. The important question is not only whether executives lied. Some did. The question is why the company needed the lies to keep working. Enron had real assets. It had pipelines. It had trading desks. It had smart people. But the center of the company became something more fragile, a confidence machine. As long as investors believed the earnings, lenders believed the balance sheet, rating agencies held the line, and counterparties kept trading, the machine could keep moving. Once confidence broke, the company did not slowly decline. It vanished. Quick recap. Every company is shaped by four forces: market, the conditions they operate in; money, how they're funded, and what that costs them; management, the decisions made at the top; moment, the timing and events they didn't choose. All four are always present. Only one is decisive. Enron is a money case. Management built the system, protected it, and rewarded it. The market gave Enron room to grow. The moment exposed the weakness. But the decisive force was money. The company depended on financial structures that made weak economics look strong until the funding trust disappeared. The market Enron entered was real. Energy deregulation created a massive opportunity. If electricity, natural gas, and other commodities could be bought, sold, hedged, and traded more freely, then a company with pipelines, information, and trading expertise could sit in the middle. That was the legitimate version of Enron's story. The company was not wrong that markets were changing. It was not wrong that energy could be financialized. It was not wrong that risk management could be valuable. But a good market can hide a bad machine. Enron kept expanding the idea of what could be traded: gas, electricity, bandwidth, weather exposure, even ideas that sounded more like PowerPoint than business. The story got bigger because the market rewarded the story. That created the first danger. When investors value growth, complexity can look like genius. When analysts reward innovation, opacity can look like sophistication. Market was powerful, but it was not decisive. The market gave Enron oxygen. Money turned oxygen into leverage. This is where the company becomes fragile. Enron's reported earnings depended heavily on accounting choices that pulled future expectations into present results. Mark-to-market accounting can be legitimate in the right setting, but in Enron's hands, long-term projections could become current profit before the cash had arrived. That creates a simple problem. If you book the future today, tomorrow has to be even bigger. The company needed more deals, more asset sales, more structures, and more market confidence to keep the picture intact. It also used special purpose entities and related party arrangements that helped move debt and losses away from the simple story investors thought they were seeing. The result was a company that looked stronger from the outside than it was on the inside. The money force was not just debt, it was credibility. Credit ratings mattered because Enron's trading business needed counterparties to trust it. Stock price mattered because some structures depended on Enron shares retaining value. Analyst confidence mattered because doubt could become self-fulfilling. So when questions started to compound, the system tightened around itself. A normal company can survive bad headlines if customers keep buying and lenders keep lending. Enron's problem was that trust was not decoration, trust was infrastructure. Once lenders, counterparties, and investors stopped believing the numbers, Enron could not fund the gap between its story and its reality. That is money decisive. Management is not innocent here. It is the mechanism. The executive culture rewarded reported performance, deal creation, financial complexity, and aggressive accounting. The company celebrated people who could create earnings from structures that outsiders could barely understand. That matters because incentives teach an organization what truth is worth. If the highest status people are the ones who make the numbers work, the organization starts to serve the numbers. If bad assets can be hidden, transferred, renamed, or marked optimistically, then reality becomes negotiable. Enron's leaders did not merely fail to see the risk, they helped build a system where risk became harder to see. But management is still not the decisive force in this episode, because management error alone does not explain the speed of the collapse. Bad decisions can take years to unwind. Enron fell apart when the financial architecture could no longer be trusted. Management built the machine. Money made the machine unstable. The moment was the break in confidence. In 2001, questions about Enron's accounting, debt, related party deals, and earnings quality became impossible to contain. The stock price fell, credit pressure grew. Dynegy walked away from a proposed rescue merger. The SEC investigation widened the sense that the company had not simply hit a rough patch, it had lost credibility. The timing mattered because Enron was not built for doubt. A manufacturer can sometimes survive a bad quarter. A retailer can survive a weak holiday season. A trader that depends on trust can die when counterparties decide the risk is no longer worth taking. That is why the final collapse felt like a trap door. The moment did not create the weakness, it revealed it. So what killed Enron? Market was real opportunity. Energy deregulation and trading did create space for a powerful intermediary. Money was decisive. Enron's financial architecture turned confidence into operating fuel. Management was the mechanism. Leaders built and defended a culture where reported numbers mattered more than economic clarity. Moment was the trigger. Once scrutiny became public and confidence broke, the system could not refinance its own story. The simple version is that Enron collapsed because executives lied. The corporate anatomy version is sharper. Enron collapsed because the company made trust part of its capital structure. When trust was abundant, Enron looked brilliant. When trust vanished, it had no floor. That is the lesson. A business can borrow money. It can borrow time. It can even borrow belief for a while. But if the business model needs belief more than cash flow, the liability is already there. It is just not on the balance sheet yet. Next case is Yahoo. It had the internet's front door, but could not decide what business it was really in. If you want the next case before it goes public, join the free corporate anatomy briefing. The link is in the description.